Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, December 20, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So the market was down slightly today. For all intents and purposes, 24 cents or 9/10 or 1/10 of 1% is pretty much a rounding error. However, the market did close poorly today, and we're going to take a look at a couple of intraday charts to display that. And that leads into poor activity or a weak market into the morning hours at minimum tomorrow. So we have the 266.25 area that we identified as a likely area where the market wants to come down at least test in and around that area. That's becoming more and more of a probability. Whether it happens tomorrow or Friday or both, we'll see. The market can actually come a little bit farther than that. As you can see, we have the 20-period moving average or home base sloping up into price. Today that comes in at 264.50. I'm not saying we get down there tomorrow, although we could, but I think the market is just due for some kind of a little pullback. You're seeing that over the last couple of days. Yesterday was a nice reversal day. Today was another reversal day from where we were this morning at the highs. And that tells you, and finishing on the lows, tells us that the market is weak and there's likely more downside coming. When we drill down into the hourly chart, you can see here that we have a bearish pattern. This is something I discuss at length all the time, and these patterns will generally play out to the downside. And when you look at market symmetry, and this is something that's taught in my course, you can see here that this is the likely scenario where the market is going to go tomorrow, 266.25, if in fact this particular bearish pattern plays out. And what we did today was we consolidated, for the most part, most of the day. The market baked in the oven in the lower range all day long, and it's more likely than not that we see an early sell tomorrow, and the target would be either 266.50 to 266.60, 266.50 down to the 266 even area. We split the difference at 266.25. You can see here on the 60-minute chart, the hourly chart, we do have the 100-period moving average as somewhat of a safety net, and you also have a double bottom down here. So the likely story is we're not going to see much more downside than that. If we did, we have a gap fill at 264, but that's a little bit much unless we have some kind of a reason that happens overnight or first thing in the morning for a hard sell. I don't see that happening, but anything is possible. I just don't think it's probable. Drilling down a little bit farther, you can see here, this is the first 10-minute candle of the day. This is the 9:40 candle, so it's open between 9:30 and 9:40, and this is what we call a gap and crap. So basically the market gapped higher and immediately crapped out, consolidated for about 30 or 40 minutes, made some lows, found low around 11 o'clock in the morning. That's not atypical. That actually is what is typical for the market. Between 10:30 and 11 o'clock, if we're selling, we find some kind of a low area. The market bounces for a while and then sells off into the afternoon. What we did today, a little bit of a bearish pattern into the close, and there you have it. So that's not uncommon. This market is simply overbought in the short term, and all we're doing, and if you go back to the daily chart, all we're doing is consolidating on the daily chart in a sideways to downward fashion. There's nothing wrong with that at all. This is essentially building energy for another move higher, and that move higher really doesn't get taken off the table until and unless we break below, on a daily chart closing basis, the 262.75. That'll be the first warning sign if we're to get a warning sign at all. A secondary, or the real warning sign if we're going to get a hard sell for a prolonged period of time, would be a weekly close below 260. So we'll see if that happens. That would be a Friday close. The market would have to close below 260 even in order for us to project real hard selling beyond that point. It's a little premature to have that discussion now. I just want to throw it out there as a just in case. Switching over to the IWM actually finished up about 30 cents today. It's down in the after-hours session, so we'll see if we're going to get any selling in the SPDR tomorrow, and across the board, we're likely going to get it in the IWM. But interestingly enough, the IWM was up today 0.2%, and the SPDR was down a little bit. So there is a bit of a divergence there. In addition to, we had the transportation average up today. So my two favorite leading indicators were up today, and the SPDR, or the S&P 500, is pointing downward. So there is a bit of a divergence, but not a big one, and it will certainly correct itself sooner than later. But all in all, there's really no change in the IWM. Everything I discussed last night remains the same. Technically speaking, this is a bearish wedge pattern that will normally play out to the downside. That holds true until and unless we close above the highs, the high being 155.41 on a daily chart closing basis. And to keep the most bullish position for the IWM intact, we want to close the month of December above this upsloping trend line. We're pretty far above that now, but anything can happen. That's where we want to be December 31, 2017, to keep the bullish picture intact in the IWM. Over at the transports, we have an up day of about 92 points. The transports, in part, got pulled up today with FedEx. FedEx was up $8.50, and that's a big component in the transportation average. But you can see that the transports are just powering forward in this extremely, extremely bullish fashion. It's overextended, but I keep saying this over and over again. Markets can stay overextended for a lot longer than people think, and certainly a lot longer than people who want to short them can stay solvent. But you can see here the 20-period moving average chasing price right up along with it. This is a very bullish market. Will obviously correct at some point in time, but right now we continue to power forward, continue to make new highs in the transports. The trend is your friend until the very end. We'll switch gears and go over to the gold market. And what you see in the gold market is we're right into the 20-period moving average. And we're also above the important level that we've been discussing for several days, which is the high of this red candle here. As long as we close above that high, then we can go on to the next pivot point. So here's a pivot. That's where we went today. And then here's the next real important level that we can get to even this week. Certainly possible. It also coincides with the convergence of the 200-period moving average, which is the black trend line, and the 50-period moving average, which is the blue trend line. So that's really where gold is telling us it wants to head, and we'll see over the next couple of days if it can get there. No new information, and there should be really no surprises in the gold market. It's pretty much doing everything we discussed over the last few days. I do want to talk about the GDX, because the GDX is also doing exactly what's expected. For anybody that's taken my course, anybody that realizes what type of pattern this was, it was very well telegraphed what GDX was going to do, and it became more obvious over the last couple of days. And here we are with a continuing move in GDX, and there's probably some more upside coming. As long as we get upside in the price of the gold metal itself, we'll most likely get more upside in GDX. When you look at GDX, GDX tends to be a leading indicator of the metal itself. It leads on the upside, it leads on the downside. And you see here when we bottomed in GDX, it was basically telling us with this big power move that the metal was also going to move higher as well. And then we went sideways for a while, and here we are again. Likely scenario is GDX wants to get up into the at least $22.75 area. $23 is in the cards. There's more upside coming in GDX, but certainly the easy money was already made in the gold mining stocks, at least for the short term. Right around $23 and even slightly before, there's going to be a ton of overhead resistance. Let me explain why. First, you have this pivot here, okay? You have the 200-period moving average. You have a gap fill area right at the same level. So right there, there's a ton of overhead resistance. And then you have the 100-period moving average sloping across the screen right above $23. So right here in this $22.80 to $23 area, there is just a ton of overhead resistance waiting for price to get up there. So price can get up there, but I wouldn't want to be long at that level. That's an area to sell into strength and take some profits. That's not an area to hop on board expecting for higher prices. Next, we'll take a look at the crude oil market. And you see here in crude oil, we got above the 20-period moving average on a closing basis yesterday, and we had a nice update today, up almost 1%, 50 cents in crude oil. But it's a nice update, and we're near the highs. This tells us that the market is bullish. We are in an uptrend. This market wants to continue higher. And if you remember, when I looked at the weekly chart with you guys the last couple of nights, what we saw was that this market is consolidating for a move higher. So that's what the crude chart is telling us. It's telling us higher prices are coming. You don't want to be short crude oil right now. The trend is your friend until the very end. And what this chart is telling us is that higher prices are coming. There's no magic. There's nothing else to discuss. You're either long crude oil with a stop knowing where you're wrong on the trade, or you're a spectator, but there's no reason to be short crude oil at this juncture. Well, for the third day in a row, the bond market got crushed today, and what it looks to me is that the bond market wants to fill this gap right here, and we're pretty darn close to it right now, so I think that's where it's headed. 3 solid down days in a row. That gap should provide support for the bond market. So, for example, let's say we came into that gap either today or tomorrow and put in some kind of a trend change signal. That would tell me that that should be an actionable event. If we put in a trend change signal and filled the gap at the same time, the likely story is you're going to get a bounce off that level. How high, it's hard to tell, but you would at least get a bounce back up to test at minimum of the 200-period moving average that slopes in up here. So this is now in a very short-term time frame, oversold in a pretty big way. So if we fill the gap, the likely story is you're going to find some support there. If we trade through it, you have double bottom down here, and if that doesn't hold, look out below. So over the last 3 days, the bond market getting taken out behind the woodshed. And with that, we'll talk about the dollar, and you can see here today we came in to test the 100-period moving average on the dollar, and the dollar's weak. It looks like it wants to go lower, but there's still a case for the ABC pattern. It's just not giving us any kind of upside momentum. Here's the B leg, so you have the A leg going up, the B leg, and if this holds, you can have the C leg in an upward fashion off this 100-period moving average, but we're in the middle of a range. It's not giving us anything definitive whatsoever, so we'll just leave it alone, but that's the best I can tell you with the dollar. We have to hold the 100-period moving average. And with that, it's everything I really wanted to discuss tonight, so I'm going to give it a wrap there. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.